Mr. Russell, so I had a personal question regarding kind of like Monday, what we're looking for, and I think it can kind of just help us apply with getting expectations for like every week. Like for me personally, I'm looking right now on the Monday splice of the Wave 7 daily, and so I threw in 1,000 DTL, and I'm trying to like kind of make a game plan for tomorrow. And so like I'm looking at a few things. So I see like we have a purple vector on like the Wave 7 daily Monday splice at 6:15:41.
Oh, not to interrupt you. Did you want to share your screen or?
I can if need be. Sure.
Yeah, share it because that way we can all learn.
Okay, yeah.
I always need to learn new stuff.
Yep. Here we go. Oop. Yeah, so I was just looking at this. So we have that high over at 6:15. And so we know that right now QQQ is at 6:11. So we're going to print out an L1 if we maintain below 6:15 until Monday open. And kind of like what can we apply off this? Because for example, if we go and look at like the 10:15 on QQQ instead, so our lower time frames going from higher time frames to lower time frames, we look around and then we see, oh, there is a pretty much a lack of open states unless we go much further down, all the way down to 587, which would be a fairly like large sized move. But if I go to like NQ 1015, I think it shows it. No, is it the 760?
So,
yeah.
So
we have
one thing. So one thing I could suggest right now, do this. So open up QQQ Wave 1 daily. And okay, so what this shows, just to get a baseline, what this shows is a relationship every Monday to every other Monday.
Wait up. Do you want the Monday splice? I can get that.
Yeah, the Monday splice. Wave 1 daily Monday splice. I'm sorry.
Yep. With I'll do 1,000 DTL.
So you can see how repetitive the market is, because on the far right, on our splicing, our lows kind of popped out right here, and then the next Monday they were already up again. So it was basically telling us from this Monday, if we were down here from that Monday, open up 200 just so it's a little bit bigger again.
Okay, yeah, I gotcha. Do you want 200 or 250? The 200 on
yeah, we're just trying to. So my goal here is just to look to the immediate.
Yeah.
So I'm just looking to this short time frame right here within the green band, and you can see the market doesn't seem super random right here recently, because we get down to the near the bottom of the green and then we try to get back up to the top of the green. You know, it looks a little bit rigged, the market. So on the Wave 1 daily, since it's a relationship from Monday to Monday to Monday to Monday, and it's showing us in an unusual fashion, this relationship. If this holds true from the last Monday, we're going to be above that close price. And I can't read what it says. 623?
Yeah, 623.23.
623.23. And what did we? I'm not even sure what we I can't remember what we closed on Friday.
Pretty sure around 612. 1 sec, I can check. We closed at like 608.50.
Okay, 608.50.
Yeah, 608.50.
So if we look left, and when we break the bottom of that structure, that average percent line, that's the bottom, it's underneath the pivot, the bottom of the green line. If we look on the left side, we've seen where our lows have been. If you catch my drift, see the red candle right there? and then the green and the red. See how the lows are similar? Like move your cursor down. Keep going down. Right there. See how those other three lows almost came out like the market's like, kind of rigged, right? They're the guys that are in the know are taking it to these low levels right here. So that implies right now, like inference, if we inferred what's been happening, we've been going down to where those crosshairs are at. Like, because the last 3 times, that's where they took it to. So the first thing I would do, and this is what I'll be doing on Monday morning, is I would put whatever the equivalent of that price is as a short side target. So if we go short, that open state down there is one of the levels, because these are the prior Mondays. So if we look at the price action, if we open down near that line, it rallied back up. If we open out of the green average percent, then it went short on the day. And then once it went down to that low, that line, then, it kind of rallied back. It bounced back. So right now, the structure is from the bottom of the green to the line you've got there, to that open line. Now, there can be other stuff in the way. The floor, we can come out and have a high floor. Like the system may start calculating that the floor is way above that. We're like, God, there's no way to get down there. But right now, since we've broken underneath that 623.23, so we violated that close, and we're at the 608 level, it's implying that on Monday, be much lower than we were on Friday. We can be lower than we were on Friday. So we have to put in the green line, because if we're above that green line there, yeah, exactly. So if we're above that, that infers that we could run a play that's on the immediate left. It will try to close above the 623.23. And keep in mind. Oh, go ahead.
Another thing I wanted to mention regarding that was the 760, because it kind of favors that short side, I'm pretty sure. I was looking at NQ and we had a double bottom all the way down. Yeah, here it is. Short side right here, we have a double bottom at 585 off of the 760 minute. So we can see that if we close below 610.72, or when we open up, 51% odds of this down cycle hitting there.
Yeah. So that's very bearish, which kind of plays into that wave 1 daily we were looking at too. So we know right now, like in the 760, we got to be outside of that green. First thing is, we know we've got to be below that green band for that to be a potential. So it sets up our if then next. So if we're below that green band, that average percent, then the anecdotal evidence on the left is that the bears will try to continue to be in force and take us down. Now, we do have a few blips where, we got a little bit below it and then they just ran out of steam. Yeah. So since we're kind of like private eyes in a way, we're doing data analysis and trying to figure out what the structure is. So the first thing to me is to have a green line in there to represent the bottom of that average percent. So, because that sets us in our heads, okay, if we get below that, what can be the market depth? How deep what's that amplitude that they can take us down to? And like you say, double bottom, open lines. The guys at the institutions will see this too, because they're doing stuff very similar to this, and they will work as a group to try to take us down until that stops, until that fells. And that's what's hard with trading, because we don't know when that'll fell. There may be some news that comes out, that information that comes out that changes the trajectory on a dime, and then it doesn't carve out down. But right now we know anecdotally that that evidence is that we'll try to, underneath that green, we'll try to carve out a deeper short side for us. Yeah, so, and then that's where the vector comes in, because then we kind of have to, I'll kind of glue myself to that and be watching it, being like, okay, are we respecting it? Are we respecting it? Is price continue to move away from it? Now, the hard part is when we get reversion, because there's always reversions. So when we're watching our vector, at some point in time, variable X, we don't know the time and we don't know the price this will occur. But this variable X, the unknown variable, we will test that vector. And that's where it gets really hard, because let's say we're in shorts, we're working down, everything looks beautiful, we're feeling pretty good. And then a test comes in. And if the test is successful and it holds, and then we start a leg down again, great, the shorts are working. If it goes up to the test and it doesn't hold and we go counter trend, then the put all of a sudden is in the red. So they're so vicious. It can be up 150%, and then the next minute you're down 50%. Because other traders have the same information and they're like, oh my God, the market looks like it's having a reversion kick in. So they'll start abandoning one side of the trade, maybe the put side. So it starts to lose value fast. Yeah, so pretty much another thing to look at on your graph down below. So the 760, so the macro's red underneath. Yeah, so it implies that, unless something happens Monday, that the market is on the short side. Friday when we left it, it was positioned on the short side. I think, and when we look at that other graph, a lot of the Mondays, we've always been positioned onto the long side. So this will be a little bit against the overall trend if we're short on Monday. But also, too, we're moving into that golden zone area. So Friday left us in a state of heading back into compression for the market to fill its gas tank to get ready for a decent move again.
Would the Monday-Friday splice be useful in this scenario?
You can, yeah. Yeah, you can do Monday, Friday too, and see what those pairs are looking like. Yeah, so kind of the same. So that's the Monday, Friday right there. Wave one.
Yeah, wave one daily Monday, Friday with a 250 DTL.
All right, gotcha. Yeah, so it kind of got a similar thing there. We've got the bottom of the green. So I wonder if we're going to try to tap that open line down there. If we could figure out some magical way to know 100% we can tap these open lines and close them, I mean, the amount of money we'd make is just ungodly. Well, the stock market would shut down because we'd have all the money. But right now, it looks like on the left, if we definitely fall out of that green average percent, Then on the way far left-hand side, we've got 2 green candles that have peaked out of the bottom of the green. So it's like there and there. So we opened up short, so it opened up down, and then through the day we rallied back up. So, and it's it's like the information. One graph kind of shows one thing, another one kind of shows something different. Here it shows that by and large, the first candle that leaves the bottom of that green average line goes green. It rallies on the day. And there's only one exception in that red candle. So I'm disregarding. So there's a red candle that's straddling the bottom of the green average line right there. So I'm disregarding that candle because that's not what happened on this other pair. If we look at the first candle that really was underneath the green on the open, if you see what I'm saying, underneath the green average line, that rallied back up. So it opened underneath, rallied up, opened underneath, rallied up, opened underneath, rallied up, opened underneath, rallied up. And we only had one time where we opened underneath red.
Yeah, another important thing that I would mention would be like, yeah, playing between like the 760, the Wave 1 daily, especially the 760. I've been using it more, and honestly I'm starting to see a bit more success using that because it's like making me hold longer and making me like plan and like run my moves out.
Yeah.
And like right here, for example, 51% odds for us to hit this on the down cycle. And then we can go over, we see on 760, 51% odds to hit 585. So we can start to see how like having a bunch of stacked double bottoms can be very favorable because we
Oh,
always
yeah.
know, yeah, on the down cycle, 51% odds to hit.
Yeah. Yeah, definitely. Definitely. Yeah, drawing those in can be very useful.
Other than that, like, so spotting like descending resistances, like, how often do you generally do that? Like when we're starting to form like lower peaks, is there some play in that, or should we generally see that it's like kind of like keeping that perfect angle, kind of
No,
like when we form stuff like this?
so what I've kind of found, and this is just through years of doing it, and you can see it on the graphs, and it's not a perfect system by any means. Trading is kind of imperfect by nature. But when we have the average top line here across the green line above the pivot, the top of that average. Yeah. So we see when we break above it, usually the next rally is a minor rally. So if we consider these, every time we break above the average percent above is a major rally, then the counter strike. So when we go short and then we go back long, it's usually more of a minor rally. So it's like the market is moving in surges. So we surge up, pull back, and then we kind of have a minor surge. It's like the people that didn't participate in that initial surge came back in and it wasn't as strong. It was a lot weaker. And that kind of tends to hold true. It's like, strong move followed by a pullback, followed by, a mediocre move. It's kind of like the people that were just late or the traders that were taking profits off and then and did rejoin but weren't as expecting as much. So we kind of see there's a lot of that type of action I'll notice in the market. Sometimes I'll try to point it out. I think I was showing it in NASDAQ. I think it was wave 20 the other day where we have resistance forming across those major peaks. And then across the minor peaks, we also have a resistance forming. So when looking at these, that's one thing to keep in mind, like what cycle are we in? It's like the volatility envelope tends to open up and then it tends to lessen. So it's a funnel. So it has the big funnel end and then it kind of comes down into the compression phase of the funnel. And with anything, the hard part is knowing when a new trend's forming. Like, if we hold true to what's been happening over like about the past year, or at least the past 6 months, we should have a bigger rally kick in. Wave one daily. Once we get down to this bottom of the green, and the next move has tending to be heading back towards the top of that green line. Not every single time, but a lot of the time it does. And on that QQQ live on the stream, I'll be showing stuff. Sometimes these contracts, one day we're at 20 cents, 10 cents, and the next day those same contracts on the open are at $3, $4, and $5. So even taking swings at this stuff and missing out, when you hit them, the upsides are just huge. So it makes up for the misses. But one thing that's hard here, I looked at the graph and it's like this represents a lot of time. So being regimented, so it's like you're always placing the same bets, the same trades. Because one thing I've noticed, like sometimes I'll get DMs from people and they'll try the trade and it doesn't work and then they're gun shy. And it's like this is like we're running a business. It's like we're buying and selling a product. So maybe here we're buying coats when the summer weather's still going strong. Nobody's buying the coats, so kind of take a loss on them. But it's the exact same principles. It's just being very, and like, I don't know, like there'll be people DM me like, oh my God, you have to have a PhD to trade and make money. And I think that's totally opposite. Like Milk's mentioned many times, the people that have higher degrees sometimes have the worst time. Because here we're using street smarts to figure this out. And to go to the left, use street smarts and be like, what are these traders, what have they been doing? The guys and girls trading this stuff. How have they been reacting to price when it gets to a certain level? That's what we're trying to figure out. Like, what are they going to do with the price once we get to the level? Are they going to take it long? Are they going to keep it short? So that's all we're playing this kind of like a game. We're just trying to figure out what could be the next move. Yeah, right now it looks like Monday, if we open down underneath that green level, there's a high potential for Monday rally back up by 4 p.m. It looks like on that graph.
Yeah, if we could go back to that, I'll just go to a smaller time frame. Could you go back to talking about how, like, when we open up, like, about how volatility, like, dampens after we hit that, I'm gonna just pull up a 25 for you. And kind of just, like...
A lot of times we'll see that. It's like on the farthest left-hand side, where the graph starts, you'll see that it was aggressively coming up for the morning. Or I don't know when it peaked out. It's probably around noon, 11:30 or something like that to noon. And then it went sideways. It was almost like you can look at that and be like, oh my God, the institutions, which they make up the majority of the volume, they were very active in buying. And then they just like all went home. It was like, okay, we had the move we were anticipating. We're done on the day. And then there wasn't a lot of, it just kind of went sideways. Because we need those guys to ride their coattails, because they're moving in the market. So a lot of the times when I'm looking at this, if we're constrained when we open up, and we're tending to be constrained by these averages, the top green average or the bottom of the green average, like you can kind of expect not to get much out of it, out of the trades, because you're like, people just aren't that interested. It's like, and so either we're starting from the low of that green average, and then we run to the top of the green average, and that kind of ends up just being the trade for the day. Off the open, we went short and down to it. So I kind of, and then especially for options, this is where selling premium, when we start getting confined, selling premium is about the only thing that works. Some days I'll mark lines and have trades, and they're just not going anywhere because we're in between these lines. So that's another thing. A lot of times, like, need to be better about this. It takes a long time to make all those comments I put in there as we're going, but I need to put in there like, oh, we're kind of trapped between the green lines, so don't be too aggressive and try to get too much out of the contracts, because there's just not the width of the market available. Break underneath the green or break above the green, that seems like, of course, that's always the best opportunity for the long or short when we're exceeding what the market's expectations are. We're going above what the market expected, because all it's doing is we're normalizing the data here. So we're using a state vector, an SVM, which is learning where the resistance and where the support's at. So it figures that out based on us training it. So we're training it to the wave and the aggregation. So we're saying, okay, use this wave and aggregation, learn this stuff, and then show me what that looks like. So we train it, and then from that it, figures out where those averages are coming in, just to know where we need to break them to have a trend. So back to when you were mentioning your red line on the options. See, the guys pricing the options, the writers, when they're underneath that red line, they're within these two green lines. When the price action is moving above the red lines, either the put or the call side, we're above this average percent. Because they're using a model that says where is the price action most likely going to be, and that's how they're pricing the contracts out. So we have to exceed that, what they're setting, what their model is showing them.
Another thing I want to mention is just like, personally for me, a lot of the time I will be trading those inflections and the bounces, breakouts, inflections. And honestly, I do see like most success when I'm just playing those inflections and playing breakout and inflection on the contract, because it really does tell you what is outpacing and what isn't.
Yeah. Those contracts would be super stellar long puts or long calls if we could always have breakouts all the time. And some days when we don't get those breakouts because of the information flow, like information flow day, the rumor mill's not going on. Then the volatility's tight, and it's like, God, you sit on those contracts, they just lose money. So, if we know that there's an information day coming up, can be like, okay, I'll get outsized volatility. Maybe I can make something on the long calls or long puts. Because mathematically it shows us this stuff, but it doesn't have anything to do with, where the market wants to be going. It's like the market working on information. I've got to have these values, because I got to know what I can get away with on a call or a put. I need to know that there's an open line up here, or we've had those 2 or 3 open lines right there. So that gives me an idea of the strike I can use, what I can cheat the market out of, what I can exploit it for. Because if I don't know, like on some of these, like we may be at 50 cents and they'll run to $2, $3, $4, $5, $8, $9. If I didn't know that potential was there, I would have no idea I could use that strike and get that upside. So here, at least I know where we're confined. I know where those upsides, and I know it in a rising market that price is never touched. So as we get above the high prices, you can figure that out. Like Avgo in 2023 in Periscope, Avgo hit 14,000% one day. After that, Avgo just kept churning out money. I mean, the thing's like an ATM. And I could go in there and see the opens and stuff, so I could see what call sides I could get away with. And it was like, I mean, some of them were like $3 going to 70, $4 going to 80, $1.50 going to 50. So there was like a lot of movement in it. Oh, hang on one second. Hello. I'm back
Hello.
again.
Yeah, we hear you. I was just pulling up Tesla. Something I've been looking at lately, it was the Wave 50 60-minute. It's been nice.
Yeah, that Tesla 760. Yeah, that thing's been the golden child on it. For me, it's like, it's uncanny how it's been. Yeah, that we've had a few dropouts of the average, but for the most part, it's been kind of spinning around the top line average and the bottom line average for a while, long time. Yeah, on Friday, Tesla and AMD, oh my God, it just, both those I was showing on the live stream, and they really worked out well.
Another cool thing that I do want to note is like, look at how we had a DBL bottom before we had this massive downturn. You can, there's always that statistic. When you're in a down cycle, every down cycle, when you have a DBL bottom, it's 51% odds to hit it. So if you don't hit it on the first time, it's 51% odds on the next, and the next, and the next, which you can try to apply, and at the same time, you can kind of use it as a way to make sure that you're running things to targets, because a lot of times not running things to target will also just ruin your trade plan, because if your wins aren't that full X, then it can mess up with your ratios and everything of just having like, because you're not defined by your winners, you're defined by your losers. However, like, if you don't have big winners, your losers will just chop you up.
Yeah, on the contracts, definitely.
Mm-hmm. Oh, yeah. Looking at this with just the odds bands, like I like the Wave 50, just because of the odd bands. Like they play very, very well off of this wave cycle time frame.
Yeah.
Is there any are there any stocks that you're kind of keeping an eye out for, Russell?
You know, the main ones like AMD, Google, Meta, you know, it's like, so I don't do these as much, but I used to do a lot of like the penny stocks, $10 and under. And after I got into options and after they started making them more affordable, I kind of backed away from the penny stocks just because the options, you know, they can move so radically. And but yeah, at a certain point we need to start doing the penny stocks because we can really take advantage of them with the information we've got. But right now it's just mostly doing the options, showing the options with the you know, those mag 7 stocks the most part, because really like trading SPY or the Qs or IWM or, you know, Google or whatever, Meta, just trying to focus on like one thing, you know, maybe two or three things at the most. You know, sometimes I'd run with 20 something contracts and all various things, and it's very difficult to keep tabs on all that. You know, so kind of isolating it. It's sometimes the greed level gets pretty high, but you know, trying to keep it in check. It's like Stocky Jockey is mentioning. He goes, "Oh man, on the Vector, he can make, you know, $100 a day, right? $100 a day, 500 a week. You know, 24,000 a year. Just not, you know, having to fret too much and put a lot of effort into it. It's like, you know, that's pretty powerful. The other way to do it's like, of course, to buy and hold. You know, you try to find winning stocks and pray to God that they hold value over the next 10 to 20 years. I've seen really big train wrecks over my lifetime doing this. So I was mentioning the other day, this guy, he was a CPA for us, actually. He was out of this firm. Baker Tilly's now bought him, but we had this firm in town. And it, they had multiple locations around Arizona. But anyways, one of the guys that worked there, he was a partner. He had put all his money into Enron. And so he had millions of dollars in Enron. And then that big thing happened with it. And he ended up, you know, basically all that money, and he was at retirement age. So he basically went broke from that. And his wife, they had a daughter. They were counting on that money, and it just vaporized on him. He since has passed away, and now his wife is living with their daughter, like in a little place over here. And yeah, so sometimes like just maybe not trying to be exceptionally greedy and doing the options easily or just equities or something, you know. Or find maybe some penny stocks with some potential is better.
Yeah.
Sure.
Looking a little back on that, yeah, I was mentioning the wave 50-60 minute and how it plays very well on Tesla with the odds bands. If we look, let me see. Yeah, like right here, we have a few like good behaviors within the last year or so of like nice rejections. Yeah, cool stuff.
Looks pretty solid on the 56. I've never looked at the 50-60 on it, to be honest with you. That looks pretty good because it looks like it's very defined. If you can break out of the green, you have a shot at higher upside. If you kind of can't really break out of the green or it's lingering around, then kind of caps off. Yeah, and that's like what's important. It's like, can you find stuff that's kind of consistent?
That's why I know somebody was talking about it, but it's basically just using this wave button on the bottom. There's the wave minus and the wave plus, and then messing around with your DTL. I have found that like it is a very good like learning tool to just go on QQQ, try out the different time frames, and just increase and decrease the wave cycle, and see how the waves split up as you decrease your waves.
Yeah, I like that too because if there's like this kind of rule, if you can understand what you're looking at, you can be more successful at it. So, like you're saying, sometimes I'll sit there and I'll click through them and I'll be like, oh, wow, this really falls in line. You know, it's a form of curve fitting visually. And it's a simple curve fitting thing because it's doing a massive amount of computations behind the scene. So it's just kind of clicking and finding. So the system, there's more, as I've mentioned, I'm porting this over, and there's more to it. There's one thing that says auto find the wave that makes the most money. Because all I care about is making the most money. And you can click the button and it just like freaking goes out there and it figures out, which curve, which fitting works the best. And then until it doesn't, and then you click it again and it figures it out again. But right now, I haven't coded at base over, but right now, just as you're saying, if you click through it, because part of this is learning experience. I know this is like new for everybody, until they first came in here, I didn't really see anything like this. So part of it's just kind of even understand what you're looking at, so clicking through those waves helps. It's just disaggregating the market and it's framing it up to show us where the highs and the lows are at. It learns it. It's like an AI type tool, just figures it out, learns it, and shows it to us. So clicking through can really help.
Yeah, and looking back on this specifically, we have a lot of. It's just working perfectly. Like it goes, it signals K runs long, signals M runs short. Pretty much perfect.
Yeah. Yeah.
Uh,
So there. Yeah.
let me pull up AMD.
Hey, Lem.
Yep, yep.
Let's also try to get through the rest of the questions.
Oh yeah.
If anybody else has any questions, we encourage you to speak up or type it in the chat.
Let me see. So
And
we
I did
had.
have a question for Russell or Milk. As we approach the end of the year, I've heard a lot of talk about people rebalancing their portfolios. And when does that typically occur? Like now or more towards the end of December? Like, does it have an impact on what we do?
Yeah. I don't know if Milk wants to answer that or.
Kind of how earnings has an impact. I just keep hearing that the end of the year is, I don't know what time frame it is, but that there's a lot
Yeah.
of movement from institutions to, position themselves differently at the end of the year.
Yeah. And it depends on their charter. Like you can go out and find the charters of the institutions and they'll tell you in the charter what they have to do. They'll tell you like the investment when they try to recalibrate and stuff like that. So I don't know, the end of year, like since the 80s, it kind of varies. I haven't really ever checked the end of year to see if there's one single thing that is repetitive or not. I know on TV and stuff, they're always like talking about end of year. But I haven't checked personally to see what those last few days do actually myself.
Okay, thank you.
And maybe you can check and tell us.
Well, I mean,
Sure.
I'm learning that we don't really need to know some of these things because with a fractal, it's
Yeah.
all It's all
Yeah,
like
it's kind of baked
disconnected,
in.
right? Yeah.
Yeah, that's how I look at it. I'm like, what does it show? And then I just kind of go by that, whatever day it is, or, you know.
Okay, Milk just posted in chat the rebalancing portfolio end of year cycle, and that explains it a little bit.
Yeah.
Okay. Thank you,
Yeah,
Milk.
so somebody's done work on it.
User, do we have any more questions, really? I don't know if we covered everything. A lot of it was just regarding, like, spread monster and stuff, and I think we might have to wait on that until Thursday when Russell gets to the whiteboard.
Yeah, that sounds good. There was a couple of questions about the functionalities of the data warehouse. But it's kind of a vague question.
Yeah.
And then someone said, we would love to recap some fundamentals, super simple trade setups, and how the web interface can enhance them. So, and there's exclamation points, so more than one person wants to learn about that.
Yeah,
I
so
mean,
the website.
okay.
Yeah. Oh, go ahead.
No, that was the question. Go ahead, Russell. Thanks.
Oh, yeah. So the web system, you know, we've been hooking a different data provider in it, so I can get the real time options and stuff. And there's still some wrinkles with it that we're working out. And it, you know, it has the same code base as the regular Fractal system. The interface is much less. It won't have all the features that the one that we connect into has. But one thing it has are the counts. So it'll be like 1, 2, 3, 4, 5. And what that is, and I'll be watching it during the day. Like, for example, on AMD, I'll be watching it on Goog, on and all these things. Those counts are attempts to vector. So on the first attempt, it marks it. If it's under the pivot and we're under the vector, on the first attempt to get back above the vector, it will mark. It'll be a 1. On the second attempt, a 2, a third, a 3. And what it's showing us is when we look to the left, it's repetitive. It's showing us how many attempts on the left, not that it has to repeat, but it's just showing us how many attempts the bulls have been to get above the vector. And once above the vector, they'll try to get above the pivot. And the system makes a decision when it gets above the pivot. So on looking, I don't know if let's see if I have one. Let me.
I put up the QQQ
We
wave
have
10
one.
1 minute on web
Oh, okay,
version.
there you go. Awesome. So yeah, those numbers in the circles will show us how many attempts it's getting above. So of course, when we're underneath the pivot, in a perfect world, like let's say we could perfectly time everything every time, and let's say it always took 2 attempts to get above the pivot. So we would watch for the 1, and then we'd watch for the 2, and the 2's the timing tool, and that would be an entry. And we get in to the 2, it's beneath the pivot, we get above the pivot, and then let's say a 3 was a peak. So then we wait for a 3 above the pivot. It goes 1, 2, 3, getting underneath. So that would be in perfect world. Since it's imperfect and trading is based on information flow. It's also emotional to people, even at institutions. Some of the guys trading can make emotional decisions. That count, while it's showing us happen, but it may not unfold identically each time. So sometimes you might get a 1, 2, a 3 count and then go above the pivot, or sometimes you might get a 1 count and go above the pivot. But it's just another timing tool to help us see what's happening on the left, what traders are doing on the left-hand side of the graph. And because this whole thing's about being street smart, or trying to play numbers and time, basically. And we're trying to beat other traders, going at the inception of the trade as close as we can when it starts, and then trying to exit as best we can when it's about to end the trade. And in between there's our profit. So the website has that timing tool to help those number counts. So the 1, 2, 3, and they unfold in real time. Now, this thing is very complicated. So we've got an issue with it we're working on. When we're in like a very small time frame, like a wave 10 1 minute, the word open is repetitively, when it starts streaming real time, the word open, it's repetitively stacked up. Working on that, and it has to do with the way the system works. It has to this transmits deltas to the front end. For this to be fast, for us to be able to use it, it can only transmit delta information, just changes in information. And what happens is we have to go back in time and close open lines and stuff, because we can't continue to reship all the data out. The RDP system refactors the screen every time it refreshes data, so the entire screen gets redrawn. On the website, that's not how it works. If it worked that way, it would just be god awfully slow. It'd be unusable. So what's happening right now is you kind of have to just overlook it. The word open's getting recalculated, but the system's not sending out the delta information to remove the word open, because it's getting calculated as it goes. So they stack up over on the right hand side. That's why you'll see them start to stack up. But at any rate, when you watch this in the day, you'll see that the data, it's coming through a socket server we've built. So we actually take, there's tens of thousands of messages coming across the wire every second. So we actually take a sampling of those messages, because, systems you really can't, on the retail side, you really can't handle in true real time what's being pumped out of the market. It's just so fast. So what happens is, a lot of times there'll just be periods of time that the data is shipped to the front end. So that's what we do. In the back end, there's actually a interval that it pumps it out to the front end. So, this can manage it. Otherwise, it would not work right. But yeah, in real time, you can see if you come in there during the day that it will, the price action will be in movement. And it works just like the regular system. Bulls are trying to hit the open lines, bears are trying to hit the open lines below, depending upon how successful, how many of them are at any given time, the liquidity. If there's not much liquidity on the bullish side, then of course we can climb higher and higher. And so there's a version that'll be put out hopefully shortly. I thought it was going to go out by Friday. And it's you'll see some changes in it. So it's, as I bring the code over, it's going to add the bid ask band. So you're going to see this bid ask band go across the screen. and it's going to be adjusting all the time. And you'll see it where it's trying to climb or where it's trying to decline, and you'll see the spread in it and the bid ask across. So when you're watching it, it's like going to be even more information that the system's showing how the buyers and sellers are trying to move before it even happens. So it'll show it ahead of the movement.
Question regarding that, will that be only the underlying, or will that be also covering derivative contracts?
Yeah, it'll be derivatives too. There's an issue we're working on right now where, for all this stuff to work, there's a lot of magic that goes on behind the scenes. But right now there's an issue whenever a derivative is pulled up without refreshing the socket server side, it just wants to start offering up derivative data. And then when an equity is pulled up, just keeps wanting to serve out equity data. And that's a known issue that's being addressed. But yeah, it'll show the derivatives also. So it makes it a lot easier to trade the options because it's showing us the prices above. I don't know, in the live stream, sometimes I actually mark the open lines in there using the website that I know that can be achieved. So I'll pop them in there. Makes it real easy to trade them.
Yeah, I'm pulling up a 613 call contract for a Monday expiry.
It won't open. Since we've had the equity up, then the derivatives not gonna open. It has. So we, in the back end, we channel the data through one socket connection. And there's a lot of different data elements some are coming across different socket connections on the back end, and they're being aggregated, pipelined. So we try to pipeline everything through so we don't have to have multiple socket connections to streamline the system and make it more simple for everybody to operate. If we were an institution and we're all in the same building and we're all in the same network and stuff, some of these complexities we wouldn't have. But since we're spread around and we got to pipeline the information out to everybody's client, your home systems, your office systems, kind of creates a little more complexity in the build out. It causes issues like this. If you go back and now type in like IBM or AMD or Google or whatever, it'll pull it up. Since you first had an equity up, then it'll let you look at equities. We're still working on the future side of this, so need to get the futures data in. And then the next is just market depth, and we can add market depth and stuff like that, and do some creative things with it, as well as some other.
Mr. Russell, it seems like we're starting to approach the end of our time right now. Is there anybody else who has questions? User was talking about that.
I think Ryder was mentioning he was going to try to do a live stream too, which would help. I think it helps. The more people try to explain this stuff and learn it and teach each other, it's like the better. My wife says I'm a horrible teacher. She's like, you're the worst. She's like, you can't explain anything to me that I understand.
Well, so I have a thought. What if we just let him roll right in now and start streaming his screen, and we can stay on if people want to hang out and listen to what he's doing? You want to do that?
Yeah.
Stick around?
Yeah, that'd be good.
Okay.
If he's prepared
Ryder,
to do it.
are you good with that?
Hello?
Hi.
I was gonna do it in the public, the study group voice chat, just in case anyone wanted to see how the IV walls get made.
Oh, right, because it's public. Okay.
Yeah. I'll probably be going over there in a minute or so.
All right, sounds good. If anybody has any other questions, I think we are going to wrap it up. And thank you so much, Russell, and thank you, Lim, for helping out with the visuals.
Awesome. See, Lim's the new big gun.
I wish. I wish. I'm still far away from there, but
All right, Milk is posting the invite to the other session, and it starts around 3. So if we're going to be recording that one, we do need to change channels. But everybody is welcome to join us over there at 3 o'clock.
Alrighty, well, thanks for everyone for joining and
Thank you,
supporting
Russell.
everybody
what
has
we're
a good
doing.
weekend.
Yeah, we're looking forward to that Spud Monster whiteboard session Thursday.
Yeah. You know, if we're all in the same room and we could all whiteboard and everybody that would be like awesome.
Yeah, well, if you guys are going to Zoom it, well, I'm sure you're going to have record attendance for that
Yeah.
one.
Yeah, because it really helps, you know.
Yeah, maybe we can look and see if there's any like online programs or something, so we can like have a whiteboard for everybody and people can draw stuff and like we can look at everything.
Yeah. Yeah, that'd be awesome.
All right, well, thank you, everybody. We'll see you in the other
All
channel.
right.
Thank you, Russell.
All right. Thanks, everyone. See you over in the other
Sounds
chat
good.
room thing. All right. Bye.
Previous high of day and like right at like 10 o'clock I take a high and a low, and then I've been just wondering, like, what would you say is like a good way of determining whether or not we can whether like the trajectories are going to constrain us or not?
Yeah. So, when you do that, so if we back up and know that the exchange did that study that I referred to somewhere, it's on the web, that over 80% of the premiums were declining. That means when you draw that line from a peak volatility, you can pick any peak volatility along the timeline. Usually the most recent are the most valid. But if you pick the peak volatility like you're doing and draw it as 0, unless there's a trend intact, the price action will loosely follow that line to 0. So what breaks away from that line is a trend. So the market has to do something that the writers were not anticipating. So that's what breaks it from a trend. Like, you know, like on Friday, I showed the QQQ, you know, I showed the 1 minute and the 5 minute in the lower right hand corner.
Mm-hmm.
Well, what causes growth of premium inflation is that trend. So if you go back and look at the graph on the 5 minute, you know, we went green. We had the open line that closed. And I put a note in there. I said, you know, the best chance of reversion or the best chance of counter trend trade is when they close. So that's exactly what happened. We got underneath of it. It closed it. And the participants counter trended the market. So then the 5 minute went long and it pretty much stayed long, stayed green through most of the session. The writers of the call contracts, the reason they went up in value is because their calculations were not including that move. So the calculations they were doing on those options were bearish. And the reason is, if that's not true, what I just said, they would have priced those contracts, they would have fluffed them up by another $3, $4, or $5, so that at any point in time you entered those contracts, it would still be declining. So to break that red line, when you draw that line, what you're saying is this is the expected movement of that contract. This is what the riders are anticipating. And for you to be successful counter trending, and counter trending, going against that line is harder than going with that line. So going against that line means we need a trend intact, order long. And you also typically, preferably to buy underneath that line in that case, because that's the best entry. So when you draw that line in, buying in underneath that line is the best entry. So you got to have that counter trend move. So a lot of people that do options, they're selling premium because it's like easier. It's easier to sell premium than it is to try to capture premium. Because if the contract is devaluation of the contract premium, they're being devalued. And by nature, the contracts are that way. They're just by nature, they're dead instrument, and they're designed to decay. That's why they fluff up the premium, because people that have portfolios or even do naked contracts, they want to benefit by capturing that premium. And you can see with what milk does, like at the end of the session, knowing where our ceiling is, knowing where our floor is, as we move into the end of the session, you can have like instant gratification from $2 down to zero, from $2 down to 50 cents, from $3 down to zero, $3 down to 50 cents. So you can capture like $2 in a handful of minutes, whereas trying to break the line and I'll draw this stuff out during the day, it tries my patience. And, trading tries everybody's patience, really. But to capture premium, it can take 5 hours to capture $2, what, or $3, what milk is showing is happening sometimes in 15 minutes, to capture that upside. Another interesting thing is, so I don't know if you've caught on to what milk's showing, but when you have an entry, let's say your entry's around $2 or $3, and we're heading into the ceiling floor. We're heading into the close. To participate in those spreads, there's not a massive amount of risk. Like if we know $2 to $3 is kind of the capture area, that means for it to go to $4 is very difficult. And so when you're trying to capture, it's like your upside versus your downside, your risk to reward ratio. The risk side's pretty good because it's really hard. Let's say you go in at 250 and let's say it's a bad trade, you get blown out and it goes to 3. Well, you have $50 on the line, and a lot of times to capture premium on inflation, where you're starting under that red line and you're praying that we have a trend breakout so that premium will have inflation. A lot of the times you'll see, like on the screen, option might be at 50 cents or $1. You have a $50 to $100 risk. When milk's showing it near the end of the day to try to capture, the spread, that premium, a lot of times, it may be like a $50 risk, right? Because you're at 250 and maybe you get blown out at 3, right? So you lose $50. So, the reward to risk on those can also be pretty good. But yeah, again, when you're trying to capture premium, you want to be underneath that red line. Long, you got to be positioned right. You either got to be on the put side or the call side when you have that breakout. And the 5 minute, so I like the one in 5 minute, and because it captures the essence of a trend. The 1 minute's kind of heads up ish type thing, because like we're trying to read the market, right? So the 1 minute's kind of like heads up. And then if you get the 5 minute to solidify and it gets solid, you go like we did on Friday, we go green. and then your next thing is you're like, okay, if I can have a steady state green on the 5 minute, and knowing that if we can have a green candle, talking about candles, like if we can have a green candle on the daily, that implies heading into the 3-4 o'clock range. That's going to be our peak price. So when you're getting into the contracts earlier in the day, sometimes it behoves you to hold some throughout the course of the day. And I know it's like it tries in everyone's patience. It's really hard. I get it. That's why sometimes logarithmic programming and you don't look at anything and just let a logarithm run can be helpful. You don't get emotional. So you're not really seeing what's going on with the market. But yeah, so I don't know if I answered your question, but you just need a trend to go against that line. The other thing too is, I don't show this too much, but when we start in the morning, and like we did on Friday, right? And we got a 5 minute that went green signal line. That was a steady state for a long time. And let's say you get into the calls, on inception of the trade, when it first kicks in, it's like very trying because it's a differential between starting to lose money and starting to gain money. So that right when it kicks in, and I'll see sometimes people are like, oh my God, I'm up 10%. I'm going to take the trade off. And it's at 50 cents. And then later in the day, we look up and we're like at $5. And you're like, oh my God, every 50 went to 500. If you look at the market, like, okay, what's my end goal for the day? And, I'll put those lines on, right? So, and the graphs will have a close line, maybe close line, maybe a vector line, whatever. Those become objectives. And it's like, so it's a progressive thing. You hit those and then the bulls are like, okay, I want to take that line out and move to the next and move to the next. So when we're looking at open states and we're looking at clusters and stuff, they become objectives. And I get it. It's sometimes really hard because maybe you're at 50 and then it goes to 175. So you're $50 in. Now you're peaking at 175. It's like, I take that off the table and then shoot for the next rung up, climbing the ladder. It's like, and sometimes, yeah, in hindsight, it's better to take the trade off there. There's like nothing magical out there that can tell us whether a line will or will not hold because we're trying to predict the future and the future's unwritten. I see people, like I mention all the time on Quora, they're always like back testing endlessly. And it's like, that's great and all. The fractal graphs, when they look left, that's back testing and showing us acting. But the market's very fluid and there's always new information and that's changing course. Trump starts tweeting and all of a sudden things break out long or short, or some new piece of information comes in. So, like the most clearest part of the day, trading real-time hours, 9:30 to 4, is at 4 p.m. 4 p.m., everything's evident. It's like, oh, I know what I did wrong. I know what I did right. And when we're going from 9:30 to 4, it's hazy at best. And, so when I developed this system a long time ago, I was like, I just got to see the values. And then it becomes, decision support. Once I see the values, does it look like the longs are trying to knock out to the next level? Are they being constrained, And it's just like one day, like we'll have a lot of consolidation at a level. All of a sudden it'll just break right up. And then another day we'll have a consolidation at a level that's on the long side still, and it breaks down. So it's just like, back testing till we're blue in the face. That's great and all, but the future is unwritten. So we're trying to find the trend and join in with the trend. And the options, the thing that's interesting about them, they're defined risk. So if we go in at $50, that's all I can lose. And the upsides are very unlimited, you know, like Rogue Moose was showing the PFE and Anton's showing the PFE trade this week. And yeah, it did really great. It came off the 10-cent area and, you know, it ran well over $1. And that's like excellent because the risk, even if you're like, oh my God, I'm only going to do $10, you know, do something, do one. And you know, it runs up into that area. I mean, that's a phenomenal risk reward. And the thing with trading, you know, we're trying to be right more than we're trying to be wrong, right? And right is two different things. There's win rate, that's being right. With options, win rate's not the whole story though, because you can have a low win rate, but your wins, if you're knocking 500%, 1,000%, 1,500% out, I mean, it can look pretty sweet, you know, when you have that high reward. So it's not all about that. It's like, so having a good win rate is like, you know, under the option thing, Vel is performing well. Maybe it's a low win rate in percentage terms, but you're performing well. So your win rate on the performance is great. It's beating out the successful, non-successful trades. Not sure if Big Gun, looks like he didn't show up yet. I don't think we had anything planned. I think it was just kind of like open on Thursday. So when we're in Colorado, we're trying to get a room with a whiteboard so we can go over some of the math stuff that's going on. Because I wanted to kind of explain out Spread Monster. So I need a whiteboard because it's great to explain it on the computer and Paint, but man, I love whiteboards.
Oh,
And so I can stream that.
yeah. Actually, if you are able to, I would be very, very appreciative if we could ever just like film that or something because I can't go to Denver personally. I'm all the way in New Jersey.
Yeah.
If we can like record that and like make a video out of it or just post it on UAT, I would be very thankful.
Yeah, I think the facility had Zoom or whatever on it. And so I think we're going to try to Zoom it real time and then record it. Because like we can get into math stuff. I don't want to get too heavy into math, but just kind of some cursory stuff. And like some of it's kind of eye-popping once it's explained out. It's like, oh my God. So Spread Monster, there's portions in there that I think need to be addressed so it can become even more clear, apparent as to what's going on. That thing gives a lot of information, and I'll get DMs a lot of times, and people are like, what does this mean exactly? And like DMing back and forth will be like really hard to explain concepts and stuff. So if we can whiteboard it out and just show it in real time, then everybody can ask questions. We'll just do it like a class.
Speaking of, I did have a question regarding the RG intersection. So generally, how should we kind of play that? Just play it like from close to the RG after close?
Yeah. So I was going to get into that. It's like, yeah, like what is that exactly? Because it's real confusing. Because like the standard deviation has a curve. You know, so it has the two tails left and right, and then it kind of has the hump, right? And the curve. And it's a smooth curve. And that's not how everything works. You know, in the real world, things are jagged. They're not smooth. It looks like things are not conforming. So, you know, that graph, I always mention the Galton board because I think that kind of helps visualize it a little bit. So yeah, I was going to talk to that RG intersection and talk to the tells on the right hand side that are incoming, how those exactly work. Because there's kind of a weird phenomenon in the market when you're hitting all-time highs that we're exploring areas that are unknown in price and time. And what will cause price acceleration is just that there is no resistance up there, and it's kind of like a free-for-all. Now, the way we do stuff, we deal with it because we're using, reflection, we're using learning things to take that information and then project it forward to us. So we're seeing how high and low traders want to take stuff, and we're doing it. We put it into percentage terms because it's easier than saying, oh, it's a 1.5 standard deviation move up here, or 2.5 down there, or whatever. That's great and all, but I like to take prices and add a percent to them, to make it easier for my brain to wrap around. So yeah, I want to get into that and how that can be used and what happens. And there's going to be some apparent stuff, I think, when we talk about it and get into it. So I was kind of waiting until I got to the whiteboard, and then we could do the Zoom call in real time. And then I can start drawing it up and make a big mess on the board, explaining it out.
Hey, Russell, normally Biggin will read back some of the questions that people are asking in chat, and we were compiling them all week. So we do have some questions. Maybe Lem can read them. Can you see that, Lem?
Yeah, in the Fractal X Hub.
Do you mind doing that?
Oh, yeah, I don't mind at all. Yeah, so about the imprints on the smaller time frame fractal charts, particularly the wave 51 minute, wave 25, wave 10, 15. How often do the imprints shift around / move up and down? Is the system constantly calculating and moving them accordingly? For these smaller time frames, how often is that?
Yeah, so that's something I wanted to address too on the whiteboard on Thursday. But in essence, what's happening is when the price action, so let's say we're on a 10-15, and the price action's above the pivot, and the price action's working up, the imprint will not be shown for that particular frame. So the system frames up the moves above pivot and below pivot. That's why we have to move the mouse back and forth to see what the price was in that particular frame. And the only reason we're doing that is we're trying to get a better understanding of how price is moving. It doesn't mean when the price is expanding up, it's going to copy something on the left. It can move higher than the most left-hand high. It can quite not get back up to the most left-hand high. But it just gives us a frame of reference. It gives us something for decision support, because the worst thing is not having anything in front of us. And, in the classic way of doing it, and you'll go to YouTube and see this all over the place, people will just take an analog graph and then they'll mark the high, they'll mark the low, they'll mark the lowest lows, the intermediate lows, intermediate highs, high highs, which is great. Here, when we open the graph, it just does it. So we just see it. And it finds the stuff that you can't see on the linear graph are easy. All these intermediate indeterminate moves where we have a lot of consolidation, then a move one way or another. So to answer your question, though, when we're long and we're getting above the pivot, the only time that imprint can get marked out is when we transition that frame. When we're moving up, that price action has to be pushed underneath the pivot. So when the system makes the decision to put it underneath the pivot, then it marks the imprint. So it's done after it moves under the pivot for a long. And for the short side, when price is under the pivot, it only marks the imprint out for that frame when it moves back above the pivot. So when we look to the right and they're getting all the little dashes to give us an idea where resistance is at and support where traders have been taking it, just so we have an idea of what we're dealing with. Only when we get the counter trend move does that frame of imprint get marked. From all the other counter trend moves, all the imprints are on there, but it's only the current move that will add a new imprint. So it has to have the counter trend kick in, because then it knows it's a static thing. It becomes etched in stone. So one pet peeve I had when I was trading Elliott Wave a long time ago was, when he came up with his Elliott Wave theory for the 1, 2, 3, 4, 5 wave count, and for corrective waves, ABC waves and stuff, is a fluid system. So I was using eSignal, which is pretty expensive, Joseph's advanced get with Elliott Wave, and it would drive me berserk because it would say, oh, here's wave 5 up here. So maybe on Microsoft Wave 5 was $500, for example, was the expected projected outcome. And then all of a sudden, the price in Microsoft did something else, either intraday or overnight. And that wave sequence became invalid, that Elliott wave sequence. And then it relabeled itself. Then all of a sudden it's an ABC wave or a 1, 2, 3 count. It was like totally different. And I was like, holy crap. Like, I can't even figure out where to mark stuff, It's like when I feel like trading for me, like, needs to be real simple. I just need to see the stuff over on the right. I just need to see some open states. It needs to be static. It can't be like here, the imprints are static. Like once they're carved out because of that counter trend, they don't change. The only thing that changes is when we open less data or more data, it can either add imprints or take imprints away because the data sample size is adjusted. So that can change the imprints on us, which is fine because, yeah, it's coupled to the data, opening of the data. And so that's the only thing that can change the imprints there. And as far as like open lines, prices and stuff, the only thing that can change that is as price, the open lines above or below the pivot, as price is going the counter trend direction, they'll recalculate. But at least when I look over, I can see the opens on that peak on the left, on the low on the left. So even though it recalculates, I kind of have an idea where it's at, So that was the whole idea behind, using state vector and clusters, just, a lot of different math techniques to show where things are falling, because another thing I used to use was linear regression. And, so I used to throw linear regression in and combine it with Elliott wave, and it would still drive me berserk because I'm like, I can't, and this is what Spread Monster addresses, and we'll touch on that on Thursday. We'll go there, and I'll explain why Spread Monster has some of the things in it, so you can have a better idea of what they are and how you can draw them on the graph. But that linear regression would drive me berserk. Because I could never figure out exactly, and there was a guy, Mike, that did a lot of, he had a PhD in mathematics, and he did a lot of stuff. We worked together, and he came up with some math stuff. We built a system around that using linear regression. But what I always felt was, in linear regression is kind of curve fitting, because you create a linear regression line, and then within that regression line you figure out your standard deviations from it. So if volatility is collapsing or expanding, your standard deviations are changing to the data, and that would drive me insane. And Spread Monster, so when we come into the red-green intersection and the red-green lines, it it's not flexing on that. That's why we do it after hours. So we do it when the market's closed so that we hook it data set and then we can see our odds within that. Then the only thing we have to worry about is when we have outliers. We move beyond, because it'll fit, you know how it figures out the normal volatility or the regular volatility. So on Thursday we had that short side that actually moved outside of normal volatility, which is not super common. You know, if you bet trades outside of normal volatility, you know, you have to go through a lot of losing trades to hit some that work. But yeah, well, I'll try to get into that more. Definitely get into it more, and I'll draw it out on the board. So I'm hoping it'll start to even make more and more sense. You know, all this.
Another a question I personally had was regarding the standard deviation. So with the standard deviation and the standard deviation squeeze, is that a normal distribution?
Yeah, so that's framed up. So it's also taking into account the wave pattern, the wave movements up and down. And, you know, like the way the charts always show, you know, you have like minus deviations, you know, plus deviations. The way the market moves is not like necessarily. So it's a cumulative. So when you start a deviation move, it accumulates from the start of that move. So when I'm always talking about, you know, whining on and on about compression, all the moves start at compression. If you can take the accumulated moves and figure out when they've been exhausted out of the market, like we're at that golden line, right? We're at the squeeze line, the deviation line. You know, you'll even see on the charts here that mathematically proves that coming off that line, that's usually where the best moves occur, long or short. And what happens is whether the move's short or long, it adjoins them. So when we're at the squeeze line, the golden zone, we can start out short. So we'll be down there and it starts to move up. And then it switches midstream. So it'll do the M and then switch into the K. And then that'll accumulate on top of it. And what that's doing is let us looking back to the left and seeing these adjoined moves, how high and low traders are taking, how much they're taking standard deviation. Like at the shops where there's a bunch of traders, they do risk mitigation. And they'll actually be watching traders through like standard deviation as one mechanism. And if a trader, like let's say we're green and we're on QQQ, like I see this all the time over all the years I've been doing this. It'll move up near 3.6, and that's kind of where it stalls out. It takes something phenomenal to break it away from that. And that's the aggregated, that accumulated standard deviation move. So we know on any given day, if we're at the squeeze line, the best move, the greatest move, would be off the squeeze line green to the 3.6. That would be kind of our max range to target. So it's, you know, it's framing up, and that way it's trying to match and trying to figure out the standard deviation on each frame, you know, the long and the short moves. So it's giving us a better idea of the overall move that we're encountering. Because you'll see a lot of the times, I'm watching grass flip up right now, as a matter of fact. And a lot of times I'll see the standard deviation, you know, it might be 0.8 and it kind of peaks, or, you know, 1.2 or whatever it is. The stocks seem to kind of have some repetition to them with that standard deviation. So if, you know, you're using linear regression with standard deviation, like in TradingView or some other thing, it it's a little more complicated because you have to take each leg. Like in that tool, it'll be like -2, and then maybe it goes to +1. So the -2 to +1 will be, in our terms, what that deviation move is. And that indicator will be like, -2 up to 1, which is fine. For me, visually, it's harder to see it because I have a harder time unless I go through a markup every single thing. I used to do that in eSignal. I'd go in there and put marks and draw lines, and it'd take me like days on end to try to measure out what the move is. Where here's, you just kind of see it instantaneously. So, because like I mentioned, all moves start at compression within those frames. So knowing where we're at in that compression period and helps us know if we're kind of in a consolidative phase or if we're down in the beginnings of a trend or a potential trend. And sometimes too, you kind of have to watch this, and I'll keep it cognizant. So like, let's say we're at the golden zone. Sometimes the first is a counter trend. So maybe we're at the golden zone, it goes short. And it starts to come out of the golden zone short. And then all of a sudden it turns and goes green. And then it goes to the 3.6. It's accumulated on top of that red movement. So that's one thing I always keep in mind too. I'm like, okay, we're in the golden zone. And are we going to have a flip and then, move radically higher? So that's one thing I keep in mind too. And it's spicy sweet because I can do that sometimes and I can be like, okay, we're red. I'm looking for a K. It's got that M, meaning short, A on it. And it just stays red, red, and red. And I'm like, God, I could have made like a fortune just, going with the red signal line and start instead of waiting. But that's kind of part of trading. It's like, at least like when I'm looking at it myself, I can identify the setup. I can identify it as short. And then it's a decision, should I participate short or should I just be like, I don't like that idea. I'm going to wait for a K, green. So one thing we do is we have that macro band above it, which is learning too on a different time frame. And it kind of is giving an idea of the overall direction. So if we're a macro green and we're getting a K, coming out of the go, certainly be a lot stronger movement. The best ones usually are just overall as a rule of thumb. When we're red and we transition to green, or when we're green and transition to red, those right in that transition area seem to be the strongest movements, and they can be very hard to predict. Because again, all this stuff is based on information flow, for either the stock or the board of directors of the economy or whatever, CEO, all that stuff. But kind of at least gives an idea, I guess.
We still have a few more questions. Here's another one from Chris G. I'm pulling it up right now. Here we go. This one's a bit more open-ended. I'd like to learn more in depth on how to locate different points of confluence across various wave/time frame charts, as well as the tools, spread monster, IV walls, and like mainly how to create like a better map for the day.
Yeah, so one thing in spread monster, our standard deviation thing, it shows all those little white lines. So when we're creating our data map, is basically when we pull it up, it's showing us a structure. So So what I'll do is, I usually don't draw this into the graphs. I sometimes do it. I will sometimes change stuff up. But what I'll do is, and Milk's religious about doing this, he'll show spread monster information daily. But I'll take that information, I'll put it into one of my graphs. So I'll take spread monster, and those white lines, those become zones. And there's two ways to look at it. Again, like for me, I don't like black box stuff that much. And a black box is where you have a bunch of input. So you input a bunch of data into the black box, and then it spews out a bunch of numbers to use. I like to visually look at it myself. So in Spread Monster, what it's doing is it's trying to organize and create this relationship of data so that we can take it and apply it to the graphs. And so for me to create a very in-depth structure, if I'm wanting to know on closing information, I use Wave 1 Daily. And then I'll use, like 500, 200, or 500. And then those bands that are white traced out become zones. Now, and there's two ways to look at that. Me, I like it visually. Other people might try to build a, neural net around that and have it identify the zones. But again, that's throwing another black box on top of stuff, so I just like to see it. But trying to so when you're trying to get more and more refinement, like you'll be doing more like wave 760 minutes, because what you're trying to do is trace out more zones, more levels, and which can be good and bad, because you can start to have so many it can get confusing. Don't know which ones you're moving through exactly. I like to have I feel like for me, less is more. And I get it. Not everybody wants to trade that way. But in Spread Monster, if you do like a 760 or a 25 or a 1015, those I really like to fall back on. And the only difference in them is how reactive they are. So a 25 more reactive than a 760. A 760, you can look on the graph and you'll see it'll last across days sometimes, the long and short moves. So when it's lasting across days, let's say on the 760 that you're looking at a graph and you're getting, on the long side, a couple of days each cycle out of it. That means a 1015 or a 25, your best trades, the trends are long. So that means if you're taking those and you're using open states or clusters or imprints or, spread monster information, the ones that are most likely going to be the best reactivity are the long side. So the supporting numbers, when you're coming down into the supporting zone, that's where you'd look for the long side. And then if you use the vector, so the vector is another aid to help us. So if you use the vector and you see that there's like a vector, like if you're at a line and there's a vector challenge coming up, that can be the buying opportunity. So you're coupling those things together. So, again, like a lot of times every day I'll show the QQQ 1 minute, I'll show the the 5 minute, and then on the 5 minute side, sometimes I put in 760 information, sometimes I have 7 daily information, or sometimes I mix them. And then on the 1 minute, a lot of times I'm using 5 minute information, like 25 minutes. And so, because I want to see this condensive stuff, and Friday was a perfect example. Those call sides did very well. And at that point in time, I could go back and look, but I didn't even bother putting in really much on the 1 minute. I just put in the 5 minute, and then in the 5 minute, I put in, I think it was a 760 in there. I said a lot of times when these things are closed, that's where we'll have reversion, because at that point in time, I was more focused on the macro side on that bigger time frame. And I think maybe in the 1 minute I did have a little bit of information, not heavy, but so I really wanted to see the 5 minute, that outer scope hold. And then we started getting buy side signals on the call side, and there's the two forms of them that are going to kick in. One is where we're preemptively trying to find a support zone before we're getting a green signal line. So sometimes, like on Friday, the call side was a buy, even though its vector, I think I was using the 1 minute vector on the call side, and the put side normally I have it just the 1 minute. So the QQQ 5 minute was closing that open line, which we know when we close, we can have reversion. Not always, but that's kind of the rule of thumb. Look for reversion. So we had a reversion. It started going up. The call side. So once we close that line, or we're at that open line, I know where to draw the line in on the call side. Before we hit it, I have no idea I can approximate it, but I don't have an exact idea where to draw it on the call side, and that's because of time decay. It's the hardest thing to trade options because of time decay. So I wait for that price action to intersect over on the QQQ 5 minute to draw it in the call side. And so there I'm introducing 760. 760 is going on the call side. Then I can draw on the QQQ 5 minute. So I'm sure if I'm answering your question exactly, but we're trying to mix and match. So I don't know if you noticed on the ES, I had the purple vector in. It stopped at that purple vector, reversed, and went up to the other purple vector. Like it was magical, right? And all I was doing was, at the time, I was just sampling the purple vector and putting it, and that was I think the QQQ purple vector. So I put the QQQ purple vector into ES. That gives me even more information that other traders will have because they're not creating confluences like that. And and Milk does a fabulous job of ES. So I don't really bother with it too much because his graphs are very detailed. Mine are like, I was throwing like 3 lines. I'm like, I'm good. His are very detailed, so they're a great learning tool because you can see his rationale for building those out. But here, so since I kind of focus on the QQQ as a teaching mechanism, I put that line in to create that correlation, which gives me a little more information than like other guys that are outside of our group that don't understand there's these correlations under the hood of stuff, and they don't understand how to create them and how to map them. And the way I'm mapping them out to create even more structure is when they occur. So when the QQQ hits a line I have on its side, I mark that on the ES. So then I know there's a correlation, and then I can tell how reactive ES is, QQQ are to the market, because sometimes they're going opposite directions. And when they're both going the same direction, that's of course when we get some of the greatest movements out of the market, when they're both long and both short. When they're fighting each other, that's when things get a little constrained. So it's hard, but I don't know if that's explaining exactly what you're after. Just kind of drilling down into lower time frame cycles, because all we're doing is we're opening the time frame. We're just using the tool to measure out the cycle. And it can be very high, low, it can be choppy or whatever, but we're seeing that. And one of the strongest things is that purple vector. So during the day, I'm not super religious about updating it because I'm watching it behind the scenes, but I will adjust it from time to time. And the market, because the purple vector is reactive to the market and it's trying to learn where the market's resistance is, it's trying to learn where the market support's at as I'm adding it, I have an idea where a short or a long can be. Because if we're above the purple vector, it comes down to it, that can be the support. If we're below the purple vector and it goes up to it, that can be the short, that can be the resistance. And I know factually we have to break it. And because when I look at the screens on the graph system, I see that that's the behavior. So we know if the behavior continues to repeat, then we can have trades around it. So, again, to get even more detail using the vector. Another thing to watch for, and this is kind of subtle, on the left side, look where the low of the purple vector's been and the high of the purple vector's been. And because sometimes the imprints are marking the high and low of the price action, but sometimes these purple vectors, when it's above the pivot, they're kind of stalling out at the same place. When the purple vector's below the pivot, sometimes it can kind of stall out at the same place. So sometimes what I'm doing too is I'm looking across and I'm being, the purple vector a lot of the time stalling out maybe at, $35 or $34. So, you can also put that to even create more detail in the graph. And as far as options go, I focus on those. The hard part is the time decay, because we can have the equity or the stock or whatever holding around these areas, and the call or the put can still keep losing value, so it gets unnerving, because you'll be like, well, the equity or whatever seems like it's holding around this level, but the options continuing to lose value, and you're like, oh my god, this is making a bad situation worse, as you're watching that. And so yeah, it can be a little bit painful in that, but